Hello, everybody. My name is Brendan Davis. I'm an independent financial advisor. The group I'm a part of, GLH&C Financial, is located in the iconic River City Bank building, the one just right here on Sunrise. Can't miss it. It looks like a riverboat. And why I'm talking to you guys today is because the state is mandating that anybody with 5 or more employees offers a retirement plan. The mandate is called CalSavers, and I'm here today to inform you about the CalSavers mandate, what's being offered by the state, and then also what are the alternatives if you don't want to be a part of the state's program. So let's jump right in. So what exactly is CalSavers? What is the mandate, and why do we have it? It's estimated that 57% of people who are employed in California don't have any sort of retirement plan offered to them from their employer. The federal government has tried to pass numerous times federal level mandate / retirement plan. They haven't been successful. There may be one coming, but that's a talk for a different day. What happened here in California is Jerry Brown in 2016 signed into law a state-run IRA and a mandate that goes along with it. CalSavers, the state-run IRA, officially opened in 2019. It requires participation from all California businesses with 5 or more employees to offer some sort of retirement plan, whether it's from the state-mandated CalSavers. You can offer a different type of retirement plan. We're going to talk about the other options here in a minute. But it's just really important that you offer some sort of retirement plan to employees. And if you don't, you'll be up against some fines from the state. So it's really important. What will happen is if you don't offer any sort of retirement plan, you'll receive a notice. And then after 90 days of receiving the notice, if you don't have a retirement plan set up, you're going to be fined $250 per employee. And if you still don't offer a retirement plan after that, after 180 days of receiving the notice, you're going to get another $500 fine per employee. So it's really important that you're compliant with this mandate. So I took this flyer that's on the slide here in front of you off of the CalSavers website. So what exactly is CalSavers? It's essentially a Roth IRA that's payroll deduction that's offered through the state. Anybody who is an employee who's 18 or older can contribute to the CalSavers if you're a part of it. This is funded strictly by employee contributions. Employers cannot contribute to employees' accounts. It's 100% on the employee to make the contributions to this. Employee participation is voluntary. But with that, employees are auto-enrolled. So what that means is you as the employer, within 30 days of hiring an employee, you have to auto-enroll them into this program and deduct 5% of their pay. It's up to the employees to say if they don't want to be a part of this program, they don't want to defer. So you have to start them out at 5% of their pay. And then every year it's going to auto-escalate by 1%, which you, the employer, have to keep track of. So it goes from 5% to 6 to 7, all the way up to 8% every year. And then this is administered, where this is actually held is through a third party called a census. So that's what the first portion of this flyer is saying. Second portion is you as the employer do have a limited role in this. So the main things that you have to do is you have to set employees up. You have to set, after you hire them, 30 days, you set them up with the program. They get a notice. It's up to the employees to opt out. And then the really big thing is that you have to make sure that you're uploading their payroll in a timely manner. And what they mean by that is within 7 days. Another key feature is that there's no fees to you, the employer. All of the fees are covered by the participant. At the bottom of this flyer, it talks about the different deadlines. If you had 100 or more employees, the deadline to offer a retirement plan was September 30th of 2020. 50 or more employees, you had to offer something last year. And then this year, 5 or more employees, you have to offer something by June 30th of this month. So it's really important that you get something set up so that you're in compliant, you don't get a fine because you're not compliant with the CalSavers mandate. A couple more details that are important for you to know is just because the CalSavers program doesn't cost you, the employer, by no means is this program free. So on this side of the flyer, it talks about the expenses for CalSavers. And the expenses are actually right about 1%. So 0.83 to 0.95% per year is what it's going to cost employees if they're a part of the CalSavers program, if this is what you decide is the best thing to offer to your employees. With any sort of retirement plan or retirement account, there's investment options. And through the CalSavers program, employees have a whole 5 investment options that they can choose from. So CalSavers sounds great. What are some of the issues with this program? What are some of the cons? And I would say the biggest thing is it doesn't benefit you, the employer, to offer this program. One of the big things with the other types of retirement programs is there's a lot of tax deferral that's offered through retirement plans. So essentially you're taking money, you're not paying taxes on it today when you're most likely in a higher tax bracket, and then using it tomorrow when you're most likely in a lower tax bracket. CalSavers doesn't offer anything like that to you, the employer, no profit sharing, anything like that. Another issue is that you can't reward employees. If you have a good year, you want to share profit, something like that, you can't do a profit sharing with CalSavers. It's strictly money out of employees' paychecks that goes into the CalSavers program. And also, where this has the potential to get hairy, especially for some employers with a lot of part-time, seasonal workers, maybe you have people that work over the summer that are in college, something like that, is that everybody that's 18 and over that earns $1 is eligible for the CalSavers program. And you have to enroll these people, you have to auto-enroll them, you have to auto-escalate, you have to keep track of all of that with all of the employees. So it has a potential to get hairy if you have a lot of part-timers, if you have a lot of seasonal workers, anything like that. Could be quite a bit to administer. And lastly, not everybody's eligible for a Roth IRA, whether it's because of your income's too high, maybe your spouse's income's too high. If you're married filing separately, you're not eligible for a Roth IRA. So this has the potential to be an issue if you auto-enroll people, money's going into their paychecks into the CalSavers out of their paychecks, and then they're not eligible for a Roth IRA. This has the potential that employees aren't going to be very happy when they have to reverse what was done automatically for them. So those are some of the issues with the state's program. So let's look at some of the alternatives if you don't want to be a part of the CalSavers state-run IRA. There's multiple different options that are available to you, and I've created this flow chart to kind of help you digest what's available to you and when you might use one over the other. So let's take a look at this together to see what's offered. The first question at the top is, do you have employees? If the answer is no, CalSavers mandate doesn't apply to you. But what you can do is you can do what's called a SEP IRA. And a good way to think about a SEP IRA is that essentially it's an IRA on steroids. And how a SEP IRA works is you can defer up to 25% of what you make, up to $61,000, and you can put it in the SEP IRA. It'll save you a lot of money on taxes. And with this, only employers can make contributions to this. So technically you can have employees and have a SEP IRA, but generally I don't really see that option used because you as the employer have to contribute the same percentage of your pay to all employees' accounts if you decide to use it. So for example, if I'm the employer, I make $100,000 per year, and I want to put 25% of my pay into my SEP IRA. It's great. I can put $25,000 into it. If I have an employee, say they make $50,000 per year, because I'm putting 25% of my pay in, I also have to put in 25% for them. So that employee, I'd have to put $12,500 in for that year that I decide to contribute. So generally, I don't see employers wanting to do that. When I see these used when it's multiple people, is generally when it's a spouse team. It works really great for that. These are really easy to set up and administer. Or also, for example, I have somebody that's father-son team where they don't mind contributing to their son's retirement account. And with this, like a lot of other retirement plans, you can exclude people. So if you say it's you and you have an employee that's under 21, if they're under 21, they can be excluded from your SEP IRA. So it's no problem. You can offer a SEP. And also you can keep people out of your SEP IRA for up to 3 years. So if you have, say you have 5 employees and they're all under 21, you could potentially offer a SEP IRA and not have to contribute to their account. But generally, I don't see this offered for people with no employees. So on the other side of things, which probably applies to you if you're up against the CalSavers mandate, is yes, I do have employees. First question to ask yourself is, do you want to contribute to employees' accounts? And if the answer is no, there's 2 options that are available. The first one, if you're looking for something that's low cost, easy to administer, you can do what's called a payroll deduction IRA. And the payroll deduction IRA is very, very similar to the CalSavers state-run IRA. Some of the key differences are that you can choose Roth or pre-tax with that. So you have a little more flexibility there. And then also the investments that can be offered through a payroll deduction IRA are pretty much endless. You're not just limited to the 5 investment options that are through the state. This is potentially lower cost than the state's program, depending on how you set it up, where the investments are held, all of that. The one key thing that needs to happen, though, is if you want to offer a payroll deduction IRA to your employees and avoid CalSavers, is that it must include automatic enrollment, just like the CalSavers program. So the next option, it actually falls into if you don't want to contribute to employees' accounts, or if you do, is 401k. And a 401k offers high limits for how much can be contributed to the account. And also there's a ton of plan design flexibility. If you want to contribute to employees, if you don't want to contribute to employees' accounts, you can do all that with a 401k. Some of the key features is the contribution limits are high, With a 401k, you or your employees can contribute out of their paychecks $20,500 per year. If you're over 50 years old, you get an extra $6,500 per year you can contribute out of your paycheck. So $27,000 per year. If you're over 50, that's a pretty sizable amount that you can save on taxes. With a profit sharing or with an employer match, those limits go up. They're on top of the 27,000 or 20,500 or the 27,000. You can contribute a total amount that can go into your account is $61,000 with the profit sharing or match. And if you're over 50, you get the extra, that's $67,500 that can go into your account per year if you're a generous employer and do a profit sharing or match, something along those lines. One nice thing with a 401k is that you can exclude people. So if you have a lot of part-time, seasonal employees, you can keep people out of your 401k for works out to about 1 year before you have to offer it to them. You can keep out anybody under 21 years old. And then you can also keep out part-timers, anybody that works less than 1,000 hours. You can make the qualifications for your 401k less restrictive than that, but those are the maximum restrictions that you can put into place. There's a lot of different investment options that can be offered with a 401k. How these are generally set up is there's a fund menu. So you start your 401k. There's a fund menu generally of about 30 different mutual funds that employees can pick from. And from that fund menu, they're allowed any mix of the funds that are offered. And generally, you work with a financial advisor to pick those 30 different investments that employees can choose from. And one thing that's really important, whether it's with this or any sort of retirement plan, is you want to make sure that your employees direct their own investments in their account, which you can do with a 401k. But why that's really important is because some people do what's called a pooled 401k or a pooled retirement plan, where everybody's money gets pulled together and it's invested in the same thing. Why that can be bad for you, the employer, is you're essentially taking on all of the investment risk there. So by making it each account individual, the employees are assuming that risk. So you don't want to be tied up with you invested the money inappropriate. For me, the 20-year-old, when you're in your 50s, and it can just get really messy if there's an issue there. So you want to make sure that employees' accounts are directed, which a 401k absolutely can offer. And also employer contributions and also plan expenses are a tax-deductible expense. So why doesn't everybody do a 401k? It sounds great. What are the cons? One of the things is that 401ks, because there's so many different options, they can be really complex. They take time to set up, and then they also take time to administer. There's certain things that that are required that you do with a 401k. So they can take a fair amount of time to run the thing. And then also, because they are so complex, you need to work with somebody that's called a third-party administrator to run your 401k. And it costs money to set up the 401k with a third-party administrator. It's going to cost a couple $1,000s. And then every year to run the calculations for profit sharing, there's things called testing. There's work involved with this that the third-party administrator has to do. It's going to cost you a couple $1,000s a year as an ongoing expense just to run the 401k. So the last option that's available to you, if you're okay with contributing some to employees' accounts, but you want something that's kind of cookie cutter, that's easy to administer, that doesn't have quite as high a contribution limits as a 401k, you can offer what's called a simple IRA. And these are simple, as the name implies. And a couple key features with a simple IRA is that employees can contribute $14,000 per year out of their paycheck. If employees are over 50, they get an extra $3,000 that they can contribute per year. So $17,000 per year is what they can contribute out of their paychecks into this. So here's where what comes in that's cookie cutter, that's mandatory with a simple IRA, is that you can either offer a 3% match. So an employee contributes 3%, you have to match that 3% of their pay that goes into the simple IRA. Or you can do what's called a 2% non-elective. So if an employee is eligible for a simple IRA, which we'll talk about eligibility, 2% is what you put into their account, whether they contribute or not. You can do one or the other. You can do the match or the non-elective. You can't do both. So you get to choose one of those. And with this account, you can exclude people for a certain amount of time. And how it works is you can exclude people for up to 2 years, or if they make under $5,000. So they have to. You can make things less restrictive than that. You can't make it more restrictive. With this, employees direct their own accounts. You kind of take your hands off of their investment decisions, which takes a lot of liability off you, which is great. And these are really easy to administer. So after you get this up and running, which is just some paperwork, the main things that you have to do is you have to give an annual notice to anybody that's eligible for the simple IRA plan. And then after that, if employees want to defer, it's also really important that you make sure that deferrals happen into their accounts in a timely manner. And with this, there's no cost to set this up. And really the only cost to you is that you have to offer the employer match. For people that are looking to set something up for employees but don't want a kind of a full-blown responsibility of a 401k, this is generally what I recommend. This is the easiest, fastest to get set up, and also the easiest to administer. The downside to these is that it really is cookie cutter. You can't change the profit sharing. It's either the 3% match or the 2% non-elective. And also the downside is that the contribution limits aren't nearly as high as a 401k, but these are really easy to get set up. And of course with these, you can do it yourself or you can work with a financial advisor. Financial advisor is really there to help you get things set up, and then also continually to help educate your employees on how the retirement plan works, to help participants enroll, and then offer education on how everything works on an ongoing basis. And if you need help, or if you have any questions on what's available, or if you need help actually getting a plan set up, please reach out to me. I'm more than happy to get you pointed in the right direction, if nothing else. And then the very last thing is, if you have a plan already set up, it's really important that you go on the CalSavers website and that you opt out to say that you already have something set up, because you don't want to be on the state's naughty list if you're already in compliance with the mandate. So thank you for listening to me today. I really hope this was helpful, and take care.